Folks, for Saturday, June 17th, we need to talk about an interesting report from Capital Economics talking about another 20% crash in multifamily. I want to catch you up an article written by Elena Botros from Fortune magazine. It was a wonderful interview with Ross Perot Jr. I think you need to go and find that article. Just search Fortune or Elena Botros. Or, of course, you can follow me on Twitter. I went ahead and retweeted it. Shout out, Elena. That was a great article. And of course, we will catch you up on the important economic news of the week. So let's get into it, folks. Let's first talk about Capital Economics. Capital Economics has come out with a report talking about U.S. apartment values potentially plunging another 20%. Now, when they talk about another 20%, that is on top of the 5% estimate that they have already crashed, taking the peak to trough collapse to 25%. All I have to say is this is exactly what we have been talking about and warning about on this channel. Let's put some of these numbers in place. Let's assume you are a multifamily investor and you have celebrated buying properties at a 3.5 cap. You have taken LP money. You have very little skin in the game. Now your $4 billion in property is worth $3 billion. Guess who suffers the loss? Okay, again, you have a $4 billion real estate portfolio. You have 25% equity. You have $3 billion in debt. The value in multifamily drops 25%. Guess who loses? The LPs lose, and they lose everything. The GP, not so much. They may lose a little bit, right? They may have skin in their own deals. Who knows? But this is what's happening. This is why the commercial pain is different than residential. We have been warning about commercial real estate for a while. We've been warning you it's coming and it will be painful, but it's not painful like the doomers are saying. The doomers are saying commercial real estate will take down the banks. Let me be clear. They will take down a few banks. If you are a lender in San Francisco office, you are effed. If you happen to be a diversified investor who's not only concentrated in San Francisco office, you likely will be okay. Commercial real estate comes with LTVs at 60, 65, maybe 70. We didn't see 70 a bunch when there was free money. But now we're seeing 20, 25, 30% hits the value. That doesn't even touch debt. It hurts LPs. It actually turns billionaires into negative net worth. That is what's going on, right? Billionaire Barry, we joke, we talk about. Billionaire Barry is struggling. He's had a business go bankrupt. He's stopped with withdrawals or distributions. He now is selling the only thing he has left, 2,000 homes to raise cash. This is predictable. This is what we were talking about. Again, there will be lots of opportunity, right? If you can buy a $4 billion portfolio for $3 billion or 2.8 or 2.7, you are going to like that. This is why Blackstone, this is why the biggest and the baddest are already raising funds, because they're going to buy commercial stuff at a discount. They're going to buy deals from billionaires, wipe out the LPs, wipe out the equity, and just move the debt. It's so sad. It's so sad and so predictable. It's tough. Hey, folks, I don't know if you know this. Obviously, thank you for watching my channel, One Rental at a Time. Maybe you're watching on Twitter, but I want to let you know that I also have a podcast. We have a team that actually takes a couple of videos a day, strips out the video, and posts the audio. The ORAT, or One Rental at a Time podcast, has almost 8 million listens, folks. Yeah, 8 million listens. Go ahead and check it out on your favorite podcasting platform. It is there. If you do, like, subscribe, comment, whatever it is, I appreciate you. But yeah, 8 million listens for the One Rental at a Time podcast. Pretty crazy. Wells Fargo's out with a report talking about a recession is on our doorstep. Investors are falling for the Goldilocks economy. Obviously, we will hopefully be speaking with Dan Bird today. It is recording this on Sunday. Shout out Father's Day. Investors are falling for Goldilocks, price perfection. Did you know? I found this was really odd. Did you know? This is crazy, in my opinion. After the steepest rise in interest rates by the Federal Reserve in recorded history, the S&P 500 is back to where it was when rates were free. Think about that. When there was free money, and now we have a federal funds rate of over 5%. The S&P is at the same level. Now, that would not be something I would have had on my bingo card. I don't know about you. But yes, it'll be very interesting to watch going forward. I think it is rather remarkable that the S&P is at the same price value, whatever you want to call it, stock price, that it was before we started raising rates. Wild to think about, in my opinion. Let's talk about what's going on this week from economic news. First, I don't know if you know this, but Monday, the stock market will be closed for the celebration of Juneteenth. Yes, folks, the market will be closed on Monday. Tuesday, we get housing starts, and we start to get, we have a Fed speech. Now that the Fed is done with their announcement, they're out of the blackout period, so get ready for some Fed talking. I expect them to be, hey, we're going to be data dependent. We're going to go higher for longer, blah, blah, blah. Again, that's part of their talk track. Wednesday, we get Jerome Powell. Jerome Powell will be speaking. Thursday, kind of the big economic news, at least for this channel, existing home sales. From memory now, existing home sales are expected to be 4.28 million. Last month, 4.24. I am calling 4.33, both a beat on last month and a beat on expectations. If you want to play along and guess a number and potentially win a free t-shirt that says nailed it, do me a favor and leave your number below, and I will gladly mail out a shirt to anybody that nails the number. And then on Friday, we get some numbers about services and manufacturing, what is going on there as well. And then lastly, let's talk about an article from Elena Botros. Again, you can find this on Fortune. It was a wonderful interview with Ross Perot Jr. If you don't know, Ross Perot Jr. is obviously the son of a former presidential candidate who actually brought graphs to a presidential, talk track. I remember watching Ross Perot Sr. on the TV. Gosh, when was this? Was this in the late 80s? Gosh, I'm old. Anyways, he brought bar charts to talk about the federal budget and spending and all of this. And I was enamored with his handling of this. Obviously, I think he ran for president twice, which was pretty cool. It looks like Ross Perot Jr. develops commercial and residential real estate. He is a developer. He admits that for the last 40 years, real estate developers have had tailwinds, aka falling rates. Obviously, we are no longer in a falling rate environment. He sees years of pain ahead. He sees zombie office buildings. He sees capital stacks are broken. You know, folks, we don't have capital stacks are broken. We have limited partners that are toast. That is what is going on. Old office buildings are in real trouble. They are an odd footprint. Nobody wants them. They are hard real estate conversion to anything other than old office. Commercial real estate is built on debt, and we are obviously in an environment where we have liquidity drain, we have higher rates. We're going to have a lot of people that their equity is completely wiped out. At the end, commercial real estate is heading into a buying phase, not a building phase. Think about what he just said there. I think that is probably the most important quote of the article, at least for me. Commercial real estate is heading into a buying phase, not a building phase. So what does that mean to me? It means the biggest of the biggest of the baddest of the baddest are going to be shopping for busted properties, busted debt. That's exactly what I would do, exactly what we will be doing on a much, much smaller scale. There is a lot of pain. There are a lot of capital stacks that simply don't work, and the banks will either extend and pretend or force the operator to sell. I will be looking forward to doing this. We bought several office buildings, or not office, several multifamily buildings in the last crisis when the owners had to get out. And yeah, the banks took them back. So again, look for these 5 to 40 units. That's where we will be playing. But again, I think that is a great quote, which we will end on. Commercial real estate is heading into a buying phase, not a building phase. So folks, do the work. If you want, get my course, How to Get Started One Rental at a Time. It is the thing that's helping thousands of folks. If you buy it today, you can get 2 free $50 courses. They're actually $47. Hopefully you allow me a little grace, round them to $50. Also, that will allow you to get into the course Facebook group, One Rental at a Time Works. So again, folks, have a wonderful day. Take care of yourself. Later.